Welcome to the ultimate guide to permanent life insurance. Today, we'll delve deep into the fundamentals, benefits, types, and real-world examples of permanent life insurance. Whether you're a newcomer to personal finance or looking to deepen your knowledge, this video is for you. Permanent life insurance is a type of life insurance that provides coverage for the insured's entire lifetime, as long as premiums are paid. This contrasts sharply with term life insurance, which only covers a specific period. There are two main types of permanent life insurance: whole life insurance and universal life insurance. Let's start with whole life insurance. Whole life insurance offers fixed premiums, a guaranteed death benefit, and a cash value component that grows at a guaranteed rate. For example, if you purchase a $500,000 whole life insurance policy at the age of 30, your premiums will remain consistent over time, and upon your passing, your beneficiaries will receive $500,000. Next, let's explore universal life insurance. Universal life insurance is more flexible than whole life insurance. It allows policyholders to change their premium payments and adjust the death benefit within certain limits. Imagine you start with a $250,000 universal life policy. Over time, as your financial situation changes, you might increase your premiums to build more cash value, or decrease them if you're temporarily facing financial difficulty. One of the great benefits of permanent life insurance is the cash value component. The cash value grows over time, either at a fixed rate or based on market performance, depending on the policy type. You can borrow against this cash value or even withdraw it, but it's crucial to understand the potential consequences. For instance, suppose you have built a cash value of $100,000 in your policy over 20 years. You need funds for an emergency, so you borrow $50,000. It's important to repay this, as it may reduce your death benefit if not repaid. To further understand, let's look at the growth of cash value over different policy periods. Here's a graph that outlines how cash value can accumulate in a whole life insurance policy over a 30-year period. A common question is permanent life insurance worth it? The straightforward, albeit complicated answer depends on your financial goals, health situation, and investment strategy. Let's address some frequently asked questions to provide more clarity. Question: how is the cash value in a permanent life insurance policy taxed? Answer: generally, the cash value grows tax-deferred, meaning you don't pay taxes on the gains until you withdraw or borrow against it. However, there can be nuances, so consult a tax advisor for personalized advice. Question: what happens if I stop paying the premiums on my permanent life insurance? Answer: if you stop paying your premiums, the policy can lapse, but you might have options. For whole life policies, the insurer may use your cash value to cover the premiums for a period. For universal life, the cash value can also be used to cover the premium costs, but beware of depletion. Another critical aspect to consider is the comparison between term life insurance and permanent life insurance. Term life insurance offers pure life coverage for a specified period, usually at lower premiums but without the cash value component. On the other hand, permanent insurance offers lifelong coverage with cash value accumulation, but at higher premiums. It's crucial to analyze your financial needs and future goals when deciding between term and permanent life insurance. For instance, term life might be ideal if you have short-term financial obligations like a mortgage, whereas permanent life insurance can be more suitable for long-term wealth transfer and legacy planning. Let's address another example to illustrate the practical use of permanent life insurance in wealth transfer. Assume you want to leave a substantial inheritance for your grandchildren. A whole life insurance policy with a significant death benefit can ensure that they receive a guaranteed amount regardless of market conditions. Another important question: how do dividends work in a whole life insurance policy? Many whole life policies are participating, meaning they can pay dividends based on the insurer's performance. These dividends can be used to reduce premiums, accumulate as cash value, or be taken as cash. Now, let's look at a practical example of using dividends. Suppose your whole life policy pays a $700 annual dividend. You might choose to use this dividend to reduce your $2,500 annual premium, effectively paying only $1,800 that year. A critical factor in permanent life insurance is the insurance company's financial health. Before purchasing a policy, it's wise to review the insurer's ratings from agencies like AM Best, Moody's, and Standard & Poor's. Higher-rated companies are generally more reliable in fulfilling long-term obligations. Let's summarize the key benefits of permanent life insurance: lifelong coverage, cash value component, potential dividends, and the ability to borrow against the policy. However, these come with higher premiums compared to term life insurance. Thank you for watching the ultimate guide to permanent life insurance. We hope this deep dive has clarified the benefits, options, and practical applications of permanent life insurance. Feel free to leave your questions in the comments. And don't forget to like, share, and subscribe for more finance tutorials.